Hi, folks. Robert Quigley here, Washington, D.C., the Money Pit Group. We're on the road to the White House. Today, we're going to talk about Wall Street reform and the concept of fair market value. I'm going to start off by informing the public it was Friday afternoon, 3 o'clock more or less, maybe a few minutes before, maybe a few minutes after. The world famous Mike Santoli appears to be a veteran market trader, told us on CNBC that fair market value does not exist. It's a concept. It's a regime. It's basically something that when you're on Wall Street you can ignore. It doesn't make any difference. Boy, folks, this is one of the many rabbit holes, if not the number one rabbit hole, that allows Wall Street to fleece the American investing public. On the one hand, we look at the analysts in the market. There are people called research analysts that follow companies, that follow their stocks, and they actually do a CPA or accountant's dotting the I's, crossing the T's, adding up the pluses, adding up the minuses of every single company, and they come up with a fair market value. And that's what we would call the objective fair market value. But if you listen closely to the pundits on Wall Street, they will discount the analysts. The analysts are always behind. They never get it right. They're over the current stock price. They're under the current stock price. They're so wrong that they're out of the loop. Don't pay attention to them. That's the essential message that we're getting from Wall Street. But of course, this is not true. Now let me just tell you that there is a difference between objective fair market value and subjective fair market value. But let's run through some of the things in life that we all know about where we can see very clearly that there is a fair market value. So let's just take the most iconic example of your house. Now let's say you're a house seller, you wake up today and you decide you want to sell your house for $1 million. Now granted, the average house price in the country is probably somewhere between $275,000 $320,000 at this moment in time, which is May of 2022. But let's use $1 million for easy math to describe the point. So if you're a house seller and then your real estate agent says, well, okay, today, Mr. House Seller, your house is worth $100,000, so forget about it. You're not going to get any more than that amount of money. So you can put it on the market for $100,000, and you might get it sold for that amount. Now, of course, if you're the house seller and you got $1 million in this house, and you're looking at this real estate agent, you're either thinking he's too friendly with the bottle, he knows way too many drug dealers, or he's just stupid. He's nuts. No, of course your house is worth more than $100,000. I mean, objectively, if you got a Home Depot and you bought every ingredient of your house and you put it together, you're probably going to have a house cost of $400,000 or $500,000. I know, I built my own house, so I know exactly what I'm talking about here. Okay, you count the labor, you count the material cost, you've got a $500,000 house, and then if you and that's the replacement cost. So if you talk about the nice things you've done to the house, the nice fixtures, the nice decorations, the nice furniture you put in the house, and let's take into account the nice neighborhood that that $1 million house might be in. Let's add into that the local community laws that protect house property and community values, and let's look at the local property tax rate and so forth. You add all these variables together, and the house seller will say, no, Mr. Real Estate Agent, this is $1 million house, and that's what it's going to sell for. And if it doesn't sell for that, well, guess what? I'm living in this house until I die because it's not leaving my hands for $100,000. You're nuts. Now, on the other hand, If the real estate agent shows up and says, by the way, Mr. House Seller, I got good news for you. You think your house is worth $1,000,000, but it's really worth $2,000,000 today. Now, you as the house seller says, sign me up. Can we sell today? I'll live in a hotel tonight. I don't care. Well, tomorrow, that's okay too. You give me $2,000,000, I'll sign the paper. I'm out of here. Good luck. All the best to you. That's subjective value, fair market value. Subjective, fair market value. Now, clearly, neither one of those things are going to happen in the real estate market, or extremely rare. Let's put it that way. Let's just say there's like a 99.99% chance. It's not happening. Because in that world, we understand that there is a fair market value. We can touch it, we can feel it, we can live in it. It shelters us. We can see the utility. And we're not going to be hoodwinked into thinking that that house is worth $100,000. And but on the other hand, if someone wants to give me $2,000,000 for it, more power to them. Thank you. All right, so let's move on. Let's take the bankruptcy court case. Okay, so Company A files bankruptcy. We're in the process. There's going to come a point in the process where the judge is going to say to the bankruptcy trustee, what's the company worth as a whole and its parts? The judge is going to say any participants, whether it's the petitioner, whether it's the trustee, or whether it's potential buyers, please submit a pleading that lays out what you think that this company is worth. And they're going to have CPAs and accountants and experts in the industry value that company in the objective fair market value way. And at the end of the process, there's going to be a number. And the judge is going to look at all the evidence, and he's going to pick a number. And he's going to say, okay, fine, this is what we're going to go with. This looks like the fair market value based upon the balance probabilities. Okay, so that's the bank. So we've got objective fair market value. Okay, so let's move on. The Mergers and Acquisitions Department, M&As, when it comes to the world of stocks, they are charged with determining what the stock is going to go public at in terms of price, or what a new share issue is going to go at in terms of price. They're going to do the traditional objective fair market value analysis, just like I've described with the House or the bankruptcy court, and that's all well and good. But then, of course, we are coming to the way in which Wall Street has gamified the stock market and turned it into a gambling game where every participant should be very, very careful. Because what they've done at the end of the M&A department has done at the end of the process is they've then set upon a journey to figure out what's the most people will pay for the stock. Holy cow. That is about as subjective as you can possibly be. And it gets worse with the whole process, because every time Dick and Harry on a CNBC, for example, or other public financial channels, will sit around and give us reasons endlessly on why this company should be worth more than a buck, or whatever the number might be. So let's step back in time a little bit to highlight this point of public mania and what the public will pay. Let's go all the way back to the mid-1600s, to Amsterdam and tulip mania. Anybody who's in the stock market will have a passing acquaintance, at least, of the tulip mania. And back in those days, people in a bar, of all places, had decided to set up a business buying and selling tulip bulbs. And the tulip bulb, if you've got some genetic irregularities, it can produce some really unique color patterns. And then, of course, if something's rare, the idea is it's more expensive. So here we go. We're off to the races with the tulip mania. And at one point in time, tulips were trading for more than the cost of a house in the mid-1600s in Amsterdam. Now, you scratch your head. I mean, as soon as you hear this part of the story, you're like, man, those guys had too much beer to drink. You know, they weren't drinking enough water. Everyone was drinking beer, and that must explain it. But it doesn't actually explain it, because what was going on, there were two things going on. It was advertised as being an extremely rare item. Therefore, because of its rarity, it was going to be worth more money. So people were out handing over sums of money. They were actually borrowing large sums of money to buy these to buy these tulip bulbs, and then they would turn around and sell them to some other fool for even more money. And the whole process ended in a massive amount of debt, which the government of the day had to wipe off. But there you got these poor old souls paying king's ransoms, amounts of money larger than what cost to buy a house for a tulip bulb. Well, there were houses in Amsterdam before the tulip mania that existed, and they still exist today. Whereas the tulip bulb itself is going to last a season at best. Now, maybe some of its genetic descendants have survived till today, but still, regardless of how you measure that, we had a mania around the value of these tulips that was encouraged by, of course, the sellers of the tulips. So they were encouraged by the participants in the market. And what was really happening was a game of musical chairs. Look for the bigger fool. Hey, if he's going to borrow the money and spend it on my tulip, let him do it, because I'm going to get the money at the end of the day. So, hey, the world is a better place, right? I mean, that's the attitude of the seller of anything. Go just rerun here and replay the guy's going to get $2 million for his $1 million house. I mean, you're all in that situation. So we got this system. It started in tulip mania. It has continued up until this day, and the fair market value does exist. Extremely important. Now let's look at a little bit more history. Joe Kennedy. He was the first secretary of the Securities and Exchange Commission. Now, as we all know, Joe Kennedy made a fortune on the stock market, and he made a bigger fortune in prohibition through the alcohol business. I mean, if something's illegal and you're selling it, well, you can charge 10 times the price, 100 times the price. It doesn't matter. I mean, you get the point. The guy was. I mean, what was it? Why was he appointed? If you want to control the thieves, appoint a thief that understands what they're doing, and that's how you're going to get control over them. Okay, hold on a second here. What did he do? What did Joe Kennedy? So his time in office basically resulted in a bunch of laws that say the participants on Wall Street must disclose. We must put all the facts on the table, and then the investing public can make their own informed decision. So essentially, to boil it all down to its most basic form, here is the evidence, here are the disclosures. Caveat emptor, buyer beware. This is a problem. This is a massive problem, okay? Because the real rabbit hole that allows Wall Street to fleece and steal from the American public is this idea of fair market value and their ability to marginalize the concept of fair market value. Ultimately, the problem are short-term traders. People that are in the market for a very short amount of time. Okay. That's the history. That's where we are. And this is fair market value. Now, where do we go from here? Well, everyone's got a value, an opinion about a value of something. I mean, it's just like politics. Everyone's got an opinion. But this is for the dining room table conversation. This is for the restaurant and friends conversation, the golf course, wherever you hang out with your friends. This is the place for that opinionated, that uninformed, unprofessional opinion on something's value, like the value of a stock or a financial instrument. In the news media, in the public airways, whether you're talking about CNBC, whether you're talking about publications, it doesn't matter. If one is in a position of authority, and if they come across as being in a position of authority, wherever they find themselves spewing that opinion, whether it's on the street corner, whether it's on TV, whether it's on the radio, whether it's on your computer screen, if that person is holding themselves out as being authoritarian on that particular value issue, then there needs to be accountability. So if you say company A is worth $20 and it never reaches $20, or it should actually be $40, and you got people losing money because of this, then that person should be liable. That's a misrepresentation. And if, for example, in the case of the example of CNBC, They are the ones who hold that license from the FCC. They're the ones who control that airwave. They're the ones that allow people to speak on that airway. And if one of their speakers mouths off an objectively unsupportable opinion as to value, not only should the speaker be liable, but the person who owns that airwave, like in this case CNBC, would be held liable. We just can't go on like this. Everybody that appears on the public airways, specifically CNBC, they're all talking their own book. They give us a massive list of irrelevant data points, a very long list of speculative reasoning. Buy stocks because of A, B, C, or D. A great example of this is, of course, AMC. AMC a year and a half ago, I mean, there are millions and millions of examples of this, but I'm just choosing stuff off the top of my head, which is they stood out to me as being glaring examples of foolishness. AMC became really popular at the beginning of the coronavirus pandemic. Lots of folks jumped into this stock. Their audience has dropped greatly over the years because of streaming, because of the internet, because of other forms of entertainment. But during the virus, they were closed. You couldn't go out in public. They gave their earnings report, and they announced to their very large shareholder group of young, uninformed investors that they bought a warehouse. Oh my gosh. AMC is worth a lot more because it bought a warehouse. Well, guys, a warehouse is a closet. Now, granted, it might be bigger than your master bedroom closet or your pantry or your shoe closet, but it's a storage area. And I grant it, warehouses can be 100,000 square feet, they can be 1 million square feet, but they're storage areas. Sometimes they're work areas. But in the case of AMC, what's going to make the company more valuable is if they were to say, well, we did have a 20% attendance rate in our movies, but now it's gone up to 90%. Okay, 90%. Now that's something to write home about. I mean, that's obviously increased the value of that company and hence that stock. So that's just one example of the total foolishness of the reasons that they put out there to justify the increase in value of a stock. So that's a problem. So in terms of law reform, I mean, we are on the road to the White House. We are going to get there. And when we get there, Wall Street is in for some serious reform. Well, one of the reforms that's going to happen is you're not going to be speaking in the public airways about the value of stocks and financial instruments unless you are a CPA, an accountant, you have studied accounting, you have studied the whole process, and you know the nuts and bolts of how to objectively value a company. And that's where we're going to go with this bit of the reform. Now, let's take Robinhood as an example. I'm no big fan of Robinhood. I'm not an enemy of Robinhood. I just find it a comical story of the time. But about a year ago, it went public, and the share price, if I remember correctly, was somewhere in the 60s. Now, this is something that can be looked up. The exact share price is not the point of their example. I'm really just trying to highlight a bigger point here of fair market value versus subjective market value and what we have to do to reform Wall Street. I mean, after all, we look at Robinhood. They had an army of small account holders. The average account holder had $400 or $500 in the account. By contrast, Charles Schwab was one of my brokers. They have an average account of about 300,000, more or less. In Robinhood, most of the young traders were trading options and crypto. That's where most of the money came from. And the underwriters decided to put this share out of the market for something in the 60s. Oh my gosh. I looked at that. I'm like, man, if you got two entrepreneurial brain cells, you would know immediately that there is something wrong. Well, today the stock trades for in the teens. It's going to single digits. It should have never gone public in the first place. So this brings up another point. We got too many companies in the stock market that should not be there. We got 11,500 stocks in North America. That's including Canada, and a very large percentage of those stocks are duds. They should have never ever been granted access to the investing public's capital. So we've gone too far to the casino side, too far to the horse racing side, and that's not what we want in our financial markets. Take SPACs as an example. SPACs is nothing. The government of the day is allowing famous people, folks with great smiles, charismatic personalities, to go out and start a SPAC, raise a bunch of money, and they make a promise to go out and buy a private company and take it public, or buy another public company and make their investors rich, and in the process scoop off, collect some big fees. This is going to come to an end. This is nonsense. If the private company did not go public, there's probably a good reason. It could be any number of reasons. One might be it's unsuitable for the public markets. Maybe it doesn't need the public markets. Maybe it's doing just fine as a private company. I mean, there you can just look into the financial details, the market details, industry details, but just doesn't make any sense. And if the idea of the SPAC is to buy another public company, that makes even less sense, because if these guys wanted to take over that public company, they could raise money and go out and buy up a controlling share in that company. I think Elon Musk is doing this with Twitter. If it's a good deal, other people will climb on board. If it's just gambling, which is what's happened with all of these SPACs pretty much, it's just loss making opportunities for people who are foolish enough to get into the gaming side of Wall Street. Another issue, another area of reform. When we get to the White House, IPOs are going to be sold to the public. We're not going to allow the investment banks to feed first at the trough. They are going to stand in line like every other member of the investing public. And if they want to build a share position in that company, they can go to the free and open markets to do it. But we're not going to allow investment banks and other middlemen to take a lion's share of the issue, and then of course turn it around and sell it to second comers or retail traders and make this whopping profit. It's not going to happen. Wall Street is changing. We're not asking Wall Street to change. We're going to make the changes. Okay, so that's where we are on fair market value. It exists. It's important. We have to cut down the influence, if not eliminate the influence, of short-term traders. And I will finish up with this reform point. When we get to the White House, we're going to institute a new fee, taxation, or penalty scheme, depending on how you want to describe it. Essentially, if the short-term trader, if they're in and out of the stock or the financial position within 1, 2, or 3 month period, the exact time period we'll do some further research, but let's just say 3 months. If someone is trading a financial instrument and they open and close that position within 3 months, 50% of those profits will immediately it'll be programmed into the broker's trading system. They will be taken out of that account and shifted over to the U.S. Treasury. No questions about it. There are going to be no offsets. There are going to be no excuses, no crying. You trade on a short-term basis like that, 50% of the profits are going to Uncle Sam, and that's the way it is. The next period, let's say we take 3 months and 1 day up to 1 year. Okay, so if you open and close a trade and you fall within that bracket, basically you're going to pay the marginal rate. You're not going to send the money into the Treasury later. It's coming out of your account through a program. All brokers will be required to program these parameters into their systems, and whatever your standard tax rate is. So let's just say you're 35% taxpayer, then 35% of that money gets moved over to the Treasury instantaneously. There are no set-offs. That's just the way it is. That's the price for being sort of a medium short-term trader. And then we finally get to the investors. Okay, we get up to like 1 year and 1 day and over. Well, once you're in that category, it's just simple capital gains. And in the capital gains world, capital gain positives and capital gain negatives would be allowed to offset each other. So, if you got 2 trades, one of them makes you $1 million and the other one loses you $200,000, you've got a you've got a net of $800,000. So you pay the capital gains on that $800,000, and good luck going to do the next trade. Because the whole idea of the law reform is we want to encourage and reward investors and long-term traders. The purpose of a stock market is to provide financing for slightly more speculative companies in the market, but by no means was the system ever designed to go to the links of Las Vegas. In fact, the odds of Wall Street are worse than the odds of Las Vegas. The gamification, the gambleization, the fleecing of the American public, it all must come to an end, and it must come to an end immediately. Now, with that, subscribe to the channel, add your comments below, join the conversation, tell me where I'm right, tell me where I'm wrong. Until next time.